And I'm actually going to throw up a technical chart, just going off some of the comments that Sophie was making about Aussie stocks. We know that this is not a cheap market. Valuations are stretched like most developed markets at the moment. But looking at this one technical, this is the moving average convergence divergence indicator, has been sitting under the signal line and trending downward for some time. Is this a suggestion that we're finally starting to see investors come to grips with the economic realities, not to mention the corporate news with Qantas today, the likes of just so terrible as well? Is that liquidity-driven kind of rally narrative finally coming to an end?
Look, I think risk appetite is certainly consolidating with, I guess, the rising COVID-19 case counts, and we do see that markets are on edge, and there is real cause for concern, especially as we see hospitalizations mounting in the US, and that's, of course, raising the prospect of new restrictions, or if not, people's own health concerns likely weighing on their behaviors, which, of course, dampens, I guess, the recovery trajectory and serves as a reminder that COVID is very much here to stay until we get a vaccine. So I think when we look at markets, tail risks are clearly active, and there is a very limited margin of safety provided by extended valuations across developed market equities, and that includes the Oz 200 as well. So they're certainly vulnerable to setbacks and, I guess, bouts of deleveraging, given those underlying fragilities that still remain. And there's a lot of uncertainty as it relates to the virus itself. But I think that although we have these moments where reality collides with this stimulus-driven sentiment that we've seen to date, those realities are not the real drivers of risk assets at present. And I guess if we take a step back, any pullback is likely to be an intermission in the overarching uptrend. Although we readily admit that, I guess, the risk reward is not that attractive for equities, given so much uncertainty and those already extended valuations, that has really been distorted by, I guess, the lack of alternatives that has proved a very powerful force to be reckoned with. And these downside risks, any number of them, will be met with action from central bankers. And the Fed have already exhibited that their pain threshold is relatively low. And I think that, coupled with that lack of appealing alternatives and the expectations that rates are going to remain low for a very extended period, and certainly with the prospect of yield curve control later this year in the US, anchoring long-term rates at very low levels, that really gives the green light for the hunt for yields. And I think it's right. Perverse, but the existence of that dynamic means, I guess, that to buy dips in equities, you don't necessarily need to be positive on the expectations of a swift economic recovery.
Eleanor, we keep talking about deglobalization as one of the kind of reality check themes out of the other side of this pandemic. So how do you trade this? Does that mean you do a much more kind of domestic portfolio?
Certainly, deglobalization is a theme that we think is ongoing in markets at the moment, and it's a theme that has certainly been accelerated by the global pandemic. But it's a very long-term thematic, and it is going to take a long time to play out, decades, if we're going to look out into the future throughout economies and certainly equity markets. But, I mean, yes, certainly focusing on domestically focused small caps, potentially outperforming large caps in that sense, local infrastructure stocks, I think defence, and as well climate change and sustainability, actually. I think when we talk about deglobalization and the reshoring effect, the concept of the comparative advantage is sometimes lost, but actually specifically, if we look at Australia, there's a very clear comparative advantage when it comes to renewables. And I guess this year, nowhere has the impact of climate change been more obvious than Australia. So I think that provides a clear impetus for investment and a fiscal focus as well, targeting not just the jobs and the economic crisis, but also the ongoing climate crisis.
Right. So let's talk about alternatives to equities, because this GTV chart on the Bloomberg right now showing how gold is really outperforming and breaking out of its recent trading range. What assets could outperform this year, given the pandemic?
Well, you certainly highlighted one of them there, and I think gold is very knowing in the fact that there is not going to be a V-shaped recovery in the economy. I think at the moment, although I guess we need the participation of the broader precious metals complex to confirm the bullish moves that we've seen in the near term, we certainly believe the big picture is still intact for gold, and we're expecting fresh all-time highs by year end. And I think it's quite clear that just as the technology sector and growth stocks are responding to lower yields, declining real rates, and the erosion of the purchasing power of fiat currencies and debt monetization, so is gold. And the opportunity cost of holding gold with those factors declines as well. And I think there's also the additional boost of those persistent virus uncertainties, wherein we don't know whether this virus is going to come back in the colder months again, and in what sort of form it will come back. And of course, those persistent geopolitical tensions as well. And we see that between the US and China and the US and Europe as well at the moment.
So, Eleanor, just quickly, the gains seem to be pretty focused, whether it's on gold or tech growth stocks. As you put in your notes, there's too much liquidity chasing too few assets. Just quickly, our markets live. Question of the day, central banks broke the markets. Your thoughts?
Look, I think it's certainly clear that there is very little price discovery in markets, and that is breeding into financial markets, I guess, an element of moral hazard and long-term financial instabilities at best. But I think it's clear as well that eventually those fundamentals will trump liquidity, although that could be certainly a long way off at this stage. And we do worry about the future as, I guess, we've seen Fed policy fuels this rampant speculation across risk assets, along with the misallocation of capital. And it really exacerbates the structural challenges that we face within our economies, like inequality. And I think that ultimately culminates in challenges that are far greater than, I guess, a market crash to overcome. Specifically talking to maybe the long-term implications for our society's social fabric and the like.